Now, one thing that I want you all to start doing and really try to discipline yourself to do it as well is I need you to avoid taking trades in a push phase. It's the most detrimental thing you could do based on this strategy. Because, as I said, if we're taking advantage of a daily candle based on its momentum, using the 4H candles to identify a bit more of the behavioral pattern that's happening within that daily candle, and the candle was pushed 12, 16 hours worth of information or has moved that within one daily candle, the likelihood of you winning a trade in a push phase gets depleted massively. Okay? Simple maths. Avoid taking trades in a push phase. How do you identify that? If the market has pushed and it looks like it's pushed, stay out. That's as simple as it should be. No one should be confused as what a push phase is or what a push phase isn't. It's just if you see it as being a push phase market, you avoid it. I don't care if Tom, Dick, or Harry in the group has taken a trade and found a beautiful level. If at the stage where you're at in your trading, you cannot identify it, stay out. That's the answer, and that's a secret. If you're taking a buy or a sell in the market and you're taking the buy into a higher high or a lower low, and you feel that the market is not going to break it or you may find problems, stay out. Again, I don't care if Tom, Dick, or Harry has found a lower high or higher low on a 5 minute, 1 minute, 30-second time frame, and you haven't, and they took the trade, they've made money, and you haven't. It doesn't matter. Your growth is dependent on your ability to be able to understand the market how you are going to understand it for the foreseeable future. Not how I see it, not how Tom sees it, not how anybody else sees it in the group. So please, please bear that in mind. If it's too close to a high or a low and you see it as too close to a high or low, stay out. Breakouts. You should all know breakouts are a no-no. Never take a breakout trade. That means that price has just broken above the previous high or low, closed below or above, and potentially could do what? Anybody know?
Return back to the level.
Correct. Well, yeah, no. It could return back to the level. So we'll class that as a retest based on patterns if you can identify it. What could it do? Yeah. Well, I don't use the word fake out, but that's a good word.
Break out, break back in.
Correct. It could break back in. Thank you. It could break out of the structure and it could break back into the structure. And then you're screwed. Now, we're going to go on to talk about these breakout retests and 50% retracement trades in a second. But there's a different criteria to that, and I'll explain later. And finally, if price is returning to a level more than 2 or 3 times, we must avoid taking the trade. Price could either be consolidating, and once consolidating, will either break to the upside or downside, with either a false breakout or a false breakout or a break back in. That is something we do not want to be a part of. Now, if what I'm talking about in terms of 2 times, I'm talking if we have a resistance, price leaves that resistance clearly enough for you to identify its left and comes back, shows a reaction and leaves again without breaking the previous low and then coming back to that level, it's a no-go. So let me draw that for you. We have a resistance level. We have price coming to this level. We have price clearly breaking the previous structural low to indicate a lower low. Coming back. This is fine for now. Leaving again, breaking the low, and then coming back. This time it's a no-no. Okay? It's a no-no. The reason for that is because if there's orders being filled and we have a reaction, and there's orders being filled and we have a reaction, there is no way in hell that price should be coming back to that level unless we are starting to consolidate or unless the market is about to make the new higher low and continue up. If that did not make sense, please let me know. We do not want price action to be a magnet to resistance or support. We are looking for price to leave a level shift in momentum, and show evidence of continuations. That's it. We're not support resistance traders, and we're definitely not looking to trade those levels on multiple occasions if it's left it before. Okay? It makes zero sense. Do we have any questions on that?
Yeah, I have a question, Rox.
Please.
You said not to trade breakouts, which I completely agree with that. But does that also exclude taking breakouts where there's a 50% retracement opportunity as well?
So I should have mentioned it. I'm talking about the 4H time frame. Okay?
Okay.
4H time frame. If the pattern on the 15-minute time frame is indicating a high, and we have a breakout of that high and a retest of that high, it's fine to take the buys. But what I want everybody to start focusing on, and if you haven't watched it, you need to go and watch it, which we'll talk about later, is learning how to master your 4H timeframes behavior. If we have a resistance level in the market and we have no clear directional bias, i.e. prices moving sideways, and then all of a sudden we have a breakout of that structure with a strong bullish pressure, we have to really be careful that price from that consolidation does not break back in. Okay, we'll talk about it further. If price is in a trending market moving up and we finally have a pullback higher low formation breakout of that structure, then that is fine to take the breakout. Okay, but not when the market has not identified to us a clear directional bias. Does that make sense, Jay?
Makes a ton of sense. Thank you so much, Rox.
That's fine. Francis, I think you unmute yourself with noise in the background. If you have a question, let me know.
Yes, Rox, do you hear me?
I do.
Yes, can you please make one example about too close to highs or lows? What do you mean about if the price is too close to highs?
Absolutely. So we have price in a push phase, exhaustion phase, structural high, 4H time frame. Now, this range to this range potentially could create 2 or 3, depending on the pair, opportunities for us to trade higher low formations based on the 15-minute time frame. Okay? The first will be the immediate higher low, which is where the wicks are created on the 4H time frame. It would then be a push phase, a slight pullback to the previous 4H for a second opportunity, and then you have another push phase in the market that could push enough to win this trade and this trade, but then create a high low here, and we don't have enough range here because when we enter the trade, we have a 10 pip stop loss with an 8 pip range back to the high that we expect it to break. So if it doesn't break this structure and it leaves this structure, what has it created?
A double top?
A double top, exactly. So that's why we need to avoid it, because we are at the stage, or should be at the stage, or get to the stage that we could identify that the higher low is going to be made, but we never know if the higher high is going to be made. So if price is too close to the previous high in an upward moving market, we know it could make a double top, so we never want to buy now, just in case we buy, price comes back to this level and then comes back down to hit our stop loss. So the range where we take our trades must always be enough from the higher low or the lower high from this point to take the trade. Does this make sense?
Yeah. Yes, clear.